that format for the exam. You got to do a little bit more work than that. So this will be kind of like that as well. So earnings per share, the topics that we're going to cover. So good news, there's no requirement under ASPE for earnings per share. So all we're going to learn about is IFRS. And earnings per share is essentially a measure of profitability of a business. So we calculate the profit earned by a business on a per share basis. And we calculate it from the vantage point or the perspective of common shareholders. Now in IFRS, IAS 33 provides guidance on earnings per share. Keep in mind, it's only required for publicly traded companies. So even if you have a private company that chooses to report under IFRS, because it is not a publicly listed company, a private company does not have to calculate EPS. Okay, so you don't have to calculate EPS if you're not publicly traded. And when it comes to reporting earnings per share, there's two types of earnings per share information that companies have to provide. And it's got to be reported on the face of the income statement, right? So usually presented right at the bottom of the statement of comprehensive income or the income statement part. There's basic earnings per share and there's diluted earnings per share. Now the calculation, the formula is EPS is calculated by dividing net income available to common shareholders by the weighted average number of common shares outstanding. So essentially there is some adjustment that is needed to the net income number. That's the earnings. Per means you're dividing. Share over here, we're not taking preferreds, it's only common shares. And because there can be transactions affecting the number of common shares outstanding during a year, we have to calculate a weighted average number. And we'll be learning more about that. So first of all, net income available to common shareholders. The calculation there is you take net income and subtract from the net income amount an amount for preferred dividends. So any dividends for preferred shareholders, and there's more to that. Now, keep in mind, you're taking net income only, not comprehensive income. So we don't calculate EPS on other comprehensive income. Recall there's, there's net income and then there's OCI, and we add that together to get comprehensive income. We don't calculate earnings per share on comprehensive income. Earnings per share is only calculated on net income. And you don't take net income willy-nilly. You've got to subtract from the net income any preferred dividends. Now, for the preferred dividend part, it depends whether the preferred shares are cumulative or not. So if the preferred shares are cumulative, you need to subtract 1 year's worth of dividend entitlement, regardless of whether the dividends were declared or not, right? So the question might say stuff like, oh, no dividends were declared during the year. Well, it doesn't matter. If you have preferred shares that are cumulative, you have to subtract 1 year's dividend. A question might say, preferred shares are cumulative and 2 years dividends are in arrears, which means for the past 2 years, dividends have not been paid. Now, you know that for cumulative preferred shares, whenever the company declares any dividend, they'll have to first pay out any unpaid dividends from the past. So I've seen students kind of get a little confused here and say, oh, if the preferred dividends are in arrears, I've got to subtract that too. No, because earnings per share is for the current time period. So the net income that the company has earned is for the current year, and the EPS that we are calculating is for the current year. So you only subtract 1 year's worth of dividend if the preferred shares are cumulative. 1 year only, no other amount. If the preferred shares are non-cumulative, then you only subtract the amount of dividends that's actually declared. There too, with the wording, we can play around. The company declared dividends totaling $60,000 on the preferred shares, out of which half have not yet been paid. We don't care how much the company's actually paid. If there's any amount of dividend that hasn't yet been paid, it'll show up as a dividend payable liability on the balance sheet. So you got to be careful there. If the amount of dividend is declared, then that dividend belongs to the preferred shareholders. So that much of net income belongs to the preferred shareholders, and by definition does not belong to the common shareholders. Common shareholders are like the hyenas we talked about, right? So once the preferred shares have been paid their dividends, whatever is remaining, the company may not pay out as a dividend this year, but it belongs to the common shareholders. That much of income belongs to the common shareholders. It'll sit in retained earnings, but that retained earnings, remember, belongs to the common shareholders. Okay, so this is very vital to keep in mind. You got to watch out whether the dividends, whether the preferred shares are cumulative or not. If they are cumulative, you want to subtract 1 year's dividend. If they are not cumulative, then you got to watch out, was any dividend declared? And if so, you subtract that. Then secondly, for the weighted average number of common shares, or WACS, some people call it VASO as well, weighted average shares outstanding. So you'll come across different terminology. What we do here is we want to weight the number of common shares that were outstanding for the year. And if you had any kind of transactions like buying back of shares or issuance of new shares that occurred during the year, we have to weight them by the fraction of the year that the particular transaction was outstanding. Now, when we do the weighting, we usually, in most of the textbook type questions or exam questions, we do the weighting by simple number of months. In practice, it is more precise to use number of days. There's 365 days in a year. So you calculate how many, because these transactions don't all have to be at the beginning of a month, or like they can happen anytime, right? So it's more precise to calculate using number of days. But for our course, you can use months and that'll be okay. There can occur stock dividends or stock splits during the year. You got to adjust, you got to use an adjustment factor when you're calculating the weighted average common shares outstanding. Something you got to keep in mind is that you can have a stock dividend or a stock split take place after the year end, but before the financial statements are authorized, they're finalized. So that, keep in mind, is an adjusting event after the year. So its implication is, even if you have a stock dividend or a stock split take place after the financial year has ended. So let's say the company has a financial year end on December 31st and financial statements are finalized February 15th. Now the company declares a stock dividend on January 25th. January 25th lies between the financial year end, so that's December 31st, and February 15th, the date on which the financial statements are finalized. So since the event occurred between that period, we will have to consider the impact of the stock split or the stock dividend and adjust the weighted average common shares. Calculate the EPS using the revised weighted average common shares. Okay, so that is one complicating factor to watch out. Some questions, right? How will questions trick you? That's one possibility. The other one is you can have a circumstance where there's contingently issuable shares. So there can be different scenarios, like the company had purchased the net assets of another company and had promised to issue extra shares if sales went up by 10%. And well, if the sales did go up by 10% during the year, it means that the particular contingency has been met, right? The conditions which would have called for additional shares to be issued, if they were met during the year, then regardless of whether shares were actually issued or not, we have to pretend as if those shares were issued when the conditions were met. Okay, so even if the shares are not actually issued, we have to include those shares, the contingently issuable shares that would have to have been issued once these conditions were met. So these are kind of on the, the esoteric side, but I've seen CPA questions delve into that. So some of you are going to be working on PEP, right? Core 1 is financial reporting is big there. So you can have some questions, multiple choice type questions sometimes thrown at you that have these little nuggets of information. All right, so we're going to take a look at calculation of basic EPS. I'm going to walk us through a couple of examples. On D2L, I've posted the actual file, the Excel file, and it's got all the solutions in there. The file that I'm going to be using in class, I have whited out some of the information just to kind of make it a little bit more logical to follow, but you have access to the entire bit of solutions there. It's totally your preference how you want to follow along. And I'm going to very quickly share this link for those of you that prefer to follow the discussion here. All right, these are fairly simple, short examples. There's lots of questions in the textbook, end of chapter problems that you can try out. My personal recommendation will be to try working on the diluted EPS, because for diluted EPS, you have to calculate basic earnings per share anyways, right? So it kind of gives you a flavoring, but when you're learning this material new, I would also recommend that you do questions which are focused on just calculating basic EPS, but they give you more rich information about lots of share transactions happening, that kind of thing, right? So these are just a couple of examples of that. So the company here, Koala Inc., it's a publicly traded company, so therefore needs to calculate earnings per share. It had 210,000 common shares outstanding on December 31st, 2019, which is basically the beginning of the 2020 year. During 2020, the company issued 8,000 shares on May 1st and retired 14,000 shares on October 31st. For 2020, the company reported net income of 229,690 after a loss from discontinued operations of 40,600. Right off the bat, I can see there's a bit of a typo here. Net income available to common shareholders. Now we've been given that net income is 229,690. Okay, so that number is given. And in this particular question, there's no preferred shares. If there's no preferred shares, the entire net income number belongs to the common shareholders. So that's pretty simple. There's nothing to subtract. However, we've been given information about discontinued operations. So if a company has discontinued operations during a year, what we got to do is report three numbers. So we got to report EPS for income from continuing operations, which is the before the discontinued operations part. Then we got to report EPS for the discontinued operation. And then finally, earnings per share for the total net income. Now, this is something that you likely learned about in Accounting 315, your first intermediate accounting. Discontinued operations, for sure, you learned about in Accounting 315. If it's been a long time, etc., remember that's a reason, it's not an excuse. You are expected to know this. So if you don't recall, go back, review so that you are up to speed with the expectations. We, from our point of view for chapter 17, need to calculate earnings per share for the three amounts. We need to calculate an EPS for continuing operations, for discontinued operations, and then finally the total. Okay, so step one, there's nothing really for us to do. We were supposed to calculate net income available to common shareholders, and that number is given to us, nothing to really calculate. Second step in calculating basic earnings per share is to figure out the weighted average number of common shares, or weighted average shares outstanding, as people say, WASO. Now, there's two ways in which that is calculated. There's an approach that your textbook shows you, and I feel the one that I'm showing you is a little bit simpler. So I'm not going to confuse you folks by showing you two different ways. If you look up the textbook solutions, you'll find they do the calculation a little bit differently. I feel it's a little bit confusing, but it's totally right. So if you prefer that approach, by all means, you can use it, or you can follow the way I'm doing it. And so as far as I'm concerned, if there was any kind of stock dividend or a stock split, I take care of that by way of an adjustment factor. But I otherwise um, do not consider them in my math, right? I just consider stock dividends and stock splits as an adjustment factor, but then I look at what else actually happened. So you got to walk with me here. So the company began the year with a certain number of shares, right? At the beginning of the year, the company had 210,000 common shares. That for us is the opening balance, right? So we have an opening balance of 210,000 shares, right? So we started the year with 210,000. Now, during the year, there are two transactions that occurred that affect the number of common shares. One is that the company issued 8,000 shares on May 1st. So when you issue shares, the number of shares goes up. And then the company retired 14,000 shares on October 31st. You retire shares, the number of shares goes down. Okay, so May 1st, the company issued shares. Right, so 210,000 shares is what they started with. May 1st, they issued 8,000 shares. And then October 31st, they retired 14,000 shares. Now, if I was to just do a calculation here and say, what's the total number of shares that this company has outstanding? You can do the math. They started with 210,000, issued 8,000, bought back 14,000. So at December 31st, 2020, right, end of the year, the actual number of shares outstanding is 204,000. That is not the weighted average shares outstanding for purposes of calculating earnings per share. The actual number of shares outstanding is 204,000, but that's not the number we're going to use for EPS. Okay, so keep that in mind. Now, in this particular space, there is no talk about any stock dividends or stock split. So as far as adjustment factor goes, my adjustment factor will be 1. Okay, so if I'm not making any adjustment, your adjustment factor score is 1. Okay, just keep that as 1. We're going to multiply 210,000 by 1. Okay, if I had say a 2-for-1 stock split, my adjustment factor would have been 2. Right, so then I would have multiplied 210,000 by 2. More on that in another example. Now, the third thing I want you to look at is what's the fraction of the year? Remember, the year's got 12 months. So what fraction of the year have these 210,000 shares been outstanding? Well, from Jan 1st, 2020 up to December 31st, 2020 as well, that's 12 months, right? So 12 out of 12. So this you kind of can do with custom formatting in Excel. So don't be too scared if you can't show that as a fraction. Kind of you can just type in 12 upon 12, and then 12 divided by 12 will show up as 1 as fraction of the year, right? So if I had half a year, the fraction, if it's showing up as a decimal, will be half, 0.5, and so on. So just put in the fraction of the year. I'm able to show it through a special formatting in Excel. Okay, so 12 out of 12 months in the year, that number was outstanding. So weighted average for this guy will be 210,000 shares times the adjustment factor times the fraction of the year, right? So 12 out of 12 is 1 as well. So 210,000 times 1 times 1 gives us a weighted average number of 210,000. And notice I've just used a formula here. I just multiplied them across. So having waited for the length of time, as well as having taken into consideration any stock dividends or stock splits that occurred during the year, my opening balance works out to 210 for the entire year. Now, the transactions that occurred during the year, they will get weighted for the length of time. Okay, they will get weighted for the length of time. For example, when we issued 8,000 shares on May 1st, May 1st means you already have had 4 months in the year gone past, right? January, February, March, April, that's over. So from the 1st of May to the end of December, that's 8 months. So fraction of the year will be 8 out of 12. Or when you put an 8 out of 12 at your end, that'll probably show up either as 2/3 or 0.666666 as a decimal fraction. That's basically what it is, right? 8 out of 12. This is just because I used a custom presentation. I'm able to show this as a number of months divided by 12, but it's just essentially just a fraction. That's all there is, right? 8 out of 12 is 2/3 or 0.667. So if you multiply that at 8,000 shares times the adjustment factor times the 8/12s, that's going to work out to 5,333. And then if you look at the retirement part, the retirement occurred on October 31st. So October's gone as well. So we're left with November, December, right? So the number of months that this particular transaction impacts is 2 months. 2 months out of 12. So 2 out of 12 is basically 1/6 or 0.166666. Either way, if you multiply that through and through, you get a reduction in the weighted average of 2,333. Add this column up and you get weighted average number of common shares outstanding throughout the year is 213,000. So actual number of shares outstanding at the beginning of the year was 210,000. Actual number of shares outstanding at the end of the year is 204,000. But the weighted average of all these, shenanigans that occurred is 213,000. All right. And this is a calculation that you should expect to be performing. I'm going to show a slightly more complicated one in E17.5, and that is sort of what I would say you should be prepared for. And that way, like, there's nothing that I can throw at you that you won't be able to handle, right? So stock dividends and stock splits, very much on the cards. So you calculated your net income available to common shareholders, then you calculate your weighted average common shares. The next thing is EPS is you divide the net income number by the weighted average number. So net income is, total net income, if you recall, is 229,690. But the company had a loss from discontinued operations of $40,600. So the 229,690 is an amount that we got after subtracting 40,600 of loss from discontinued operations. So I'm going to let you think a little bit. What should this number be? What's my income from continuing operations? Mehek, the adjustment factor is 1, so anything multiplied by 1 is itself. Okay, so if you don't have any stock splits or stock dividends, your adjustment factor is 1. If you have stock splits or stock dividends, then your adjustment factor will be some other number. Okay, and I see Tony's hand is up.
Yeah, Professor, I have a question in regarding for the fraction of year here. So for example, January 1st, 2020, we have 12, divided by 12. So is that really to the year end?
Yeah, so from that date to the end of the year. So from January 1st to the end of the year is 12 months.
So what if the year end is in November? Are we gonna do like 11 divided by?
Then this date would have been December 1st, right? So the opening balance will by definition be at the beginning of the fiscal year. So this company's fiscal year is the calendar year, but if you have a different fiscal year, that's fine. So if a company, like you said, if a company has a year end on November 30th, well, then their year must have started on December 1st of the previous calendar year.
Oh, I see. So anyway, so it looks like the beginning time will change. Okay.
Yeah.
Okay. All right. Thank
So
you.
from whatever that date is up to the end of the financial year. Okay. So did anybody think about what the income from continuing operations should be? So I get 229,690 after subtracting the income from discontinued operations. So what should my number be before? It'll be the sum of the two, right? So after subtracting 40,000, I got 229. So my number from income from continuing operations should be bigger than my net income, right? I mean, if I tried subtracting, if I said, you know, it's 189 and something, from 189, if I subtract 40,000, I'm not going to end up with 229, right? That should be commonsensical. So if you accidentally make that mistake, you know, you gotta be aware of your surroundings and circumstances, and also paying attention to what number is showing up. So, you know, it should make sense. So if I subtracted, right, if there was a loss from discontinued operations, then my income from continuing operations needs to be a bigger number. All right, so that works out to 270,290. The weighted average common shares is 213,000 through and through, right? So that number will be consistently applied to each of these available to common shareholder amounts. And then it's just the EPS is just divide the net income amount or the income available amount by the weighted average common shares. So for the first one, 270,290, divide that by 213,000, and what you get is $1.27, right? So that's my earnings per share from continuing operations. My discontinued operations is 40,600, a loss divided by 213,000. So on a per share basis, that works out to 19 cents. And thirdly, my net income, so my EPS total works out to $1.08. Now, something you got to keep in mind is that earnings per share needs to be reported in terms of how a currency is, you know, the subunits of a currency. So a dollar is broken down into 100 cents, right? So we must report our EPS in dollars and cents. So there's only 100 cents, which means 2 decimal places. You could have, right? I mean, I could have tried doing this, right? So I could have said, maybe there might have been more decimal places. That is not technically correct because we do not have fractions of cents, okay? So when you're reporting, and this is something that CPA Canada makes a big deal out of, when you're reporting EPS, because a dollar is subdivided into 100 cents, it means your EPS calculation can only go to 2 places of decimal. So if a company's EPS ends up being 0.002, well, what will be reported on the income statement would be 0.00. That's it. Does that make sense? Always report EPS to the nearest cent. Okay. Part B is just a play on this number, and they say the company issued a 3-for-1 stock split on January 31st of 2021. The company's financial statements for the year ended December 31st, 2020 were issued on February 15th, 2021. So these financial statements were finalized on February 15th, right? They were issued on February 15th. The stock split occurred on January 31st. So this stock split occurred between the financial year end and the date on which the financial statements were issued. That period is referred to as an adjustment period. So any transaction that occurs that relates to conditions that were in existence on the financial statement date, you need to record adjustments for. Well, long story short is we have to adjust our weighted average common shares for this 3-for-1 split. Now, the quick calculation would be, since we already know that the weighted average number of common shares was 213,000, and a stock split basically means before you had 1 share, after the stock split, you would own 3 shares. So for every 1 share that you had before, you will end up with 3 shares after the stock split. So if we had 213,000 shares outstanding before the stock split, after the stock split, it'll be 213,000 times 3, 639,000 shares. That's the quick calculation. But I want to show you how to do the math with the adjustment factor. So what does the adjustment factor say? Whenever the stock split happened, right? So you look at the date when the stock split happened. Any transaction before the stock split happened. This is very important. So you got to watch out for when the stock split occurred. Any transaction dates before the stock split happened, you have to adjust for the stock split. And what's my adjustment? Every 1 share that I had before, I will now have 3 shares outstanding as a result of the stock split. So the stock split has basically tripled the number of common shares outstanding. So adjustment factor will be 3. Okay, for every 1 share that I had before, the stock split results in 3 shares being split. So the math that we had done, it'll be the same math, except now the adjustment factor is 3. And why am I using 3 for all of them? Because my stock split occurred on Jan 31st of 2021. So Jan 31st of 2021, all of these dates are earlier than January 31st, 2021. So all of the transactions basically get adjusted for the stock split, adjustment factor of 3, and you notice you end up with 639,000. And for this particular example, it would have been much faster to just multiply 213,000 by 3. You would have gotten your number quickly. Okay, and then what does that do to our EPS? Since the number of shares outstanding has tripled, but nothing has happened to the net income numbers are still the same. Well, what that's going to do is your EPS will just be a third of what it was before. All right, so before we were saying EPS is $1.08. Now you would say EPS is only 36 cents. All right, so from a psychological point of view, if the company did not make this, remember, the company is going to issue its financial statements for the year ended 2020 on February 15th. If the company does not make this adjustment, an investor, a potential investor would have seen, oh yeah, every share earns $1.08. No, because if that investor was looking at the financial statements, they're already at a date after February 15th. So if they make an investment decision based on information that maybe was true as of December 31st, 2020, but if they were unaware that there had been a stock split that took place, they could end up making an investment decision that would be unwise, right? So it is to protect those investors that the accounting standard setters require companies to adjust their weighted average common shares outstanding for EPS calculation purposes for any stock splits or stock dividends that occur between the financial statement year end and the date the financial statements are issued. Now, of course, if the stock split or stock dividend had happened during the year, it would already have been included in the weighted average calculation. And that example is exercise 17.5. Does anybody have any questions before I move on to 17.5? Nope. All right. So this one's a little more involved, 17.5. So Jan 1st, 2020, Trigson Limited had 580,000 common shares outstanding. During 2020, it had the following transactions that affected the common share count. February 1st, it issued 180,000 shares. So when you issue shares, number of shares goes up. March 1st, issued a 10% stock dividend. So a stock dividend will result in more shares being issued, right? So again, shares will go up. But the method that I'm showing you, we're not going to include any extra shares for the stock dividend or the stock split. We're going to handle stock dividends and stock splits as adjustment factors, right? So the March 1st transaction, I'm not going to actually include in the math. It'll show up as an adjustment factor. All right. May 1st, acquired 200,000 common shares and retired them. So that'll reduce the number of shares. June 1st, issued a 3-for-1 stock split. And then finally, October 1st, issued 60,000 shares. The company's year end is December 31st. Trigson earned net income of $2.5 million during 2020. In addition, it had 100,000 of 8%, $100 par, non-convertible, non-cumulative preferred shares outstanding for the entire year. Because of liquidity limitations, however, the company did not declare and pay a preferred dividend in 2020, right? So no preferred dividend has been declared in 2020. The preferred shares are non-cumulative. So these are important bits of information for us to determine how much is the net income available to common shareholders. So in part A, because you have non-cumulative preferred shares and no dividends been declared, there's nothing to subtract, okay? We subtract nothing for the preferred dividends, because if the preferred shares are non-cumulative, then you only subtract dividends that were actually declared. And if they had said, you know, XYZ amount was declared, you would have subtracted that. Now, just out of curiosity, how much is the dividend? It's 8%, $100 par. So 8% of $100 gives you $8 for each preferred share. There are 100,000 preferred shares outstanding. So 100,000 shares, $8 per share. The total amount of preferred share dividend is 800,000. Nothing was declared during the year, therefore nothing is subtracted. Okay. So net income available to common shares, 2.5 mil. Next step, you want to calculate weighted average common shares. So for weighted average common shares, we began the year with 580,000, right? 580,000, that's our opening balance. The first transaction that occurred during the year is Feb 1st, we issued 180,000 shares. So issued shares, 180,000, that's going to increase the number of common shares. Then on March 1st, there's a stock dividend. We're going to keep that aside because that's an adjustment factor for us. May 1st, acquired 200,000 common shares and retired them. So when a company buys back its shares, it cancels them. And what that does is the number of shares goes down as a result. So 200,000 shares went down on May 1st. And then lastly, you've got October 1st issued 60,000 shares. So that increases the number of shares. Now, all said and done, if I will ask you how many, and I want you to please, I often drop these hints when I'm having these conversations with you folks. I could very easily have asked for 1 mark. What is the number of common shares outstanding at the end of the year? Well, all you have to do is just keep track of what's happening to the shares. And you would have to also take into account the stock dividends and stock splits as well, right? So you've got to say, okay, without taking care of the adjustment factors, I've got number of shares is 620,000, right, at the end. Now, the actual calculation of how many physical number of shares are outstanding is a little different, right? So this one is without taking into account the adjustment factors. If I say this is the number of common shares outstanding, it'll be wrong. Okay, it won't be correct. So that is why in the solution, I didn't show any like what's the actual number of shares outstanding, right? So I'm keeping that on the side. This is a shortcut calculation for simply the weighted average common shares. Now, the adjustment factor, there's got to be two adjustment factors that we have to think about. There's the stock dividend and there's the stock split. Now, the first thing that happens is on March 1st, we have a stock dividend. All right. And Mehak, we are going to come to that. That's part B of the question. We will be looking at what if the preferred shares are cumulative, what would we do? So that's a separate play on it. Okay, so stay with me here, dear. So March 1st, 10% stock dividend. So for every 100 shares that someone had outstanding earlier, a 10% stock dividend, what it does is you will get 10 shares more, right? So the number of shares basically are bumped up by 10%. So stock dividend, if you have a 10% stock dividend, the number of shares goes up by 10%. From 100%, it goes up to 110%. So adjustment factor from that, a 10% stock dividend will basically cause all the previous numbers to go up by 110%. Now, 110%, if you want to write that as a decimal fraction, 110% is 1.1. Okay, 110% is 1.1. You can put the adjustment factor as a percentage if you like. 110% is 1.1. Now, every date before March 1st is what you've got to hit with this. So March 1st, what are the dates that occurred before March 1st? Well, you have January 1st, 2020, the opening balance. I have to adjust that by 1.1. And then February 1st, I have to adjust by 1.1. May 1st, I don't adjust for the stock split because May 1st is a date that happens after the stock dividend. Okay, so I just take into account the events that occurred before the stock split. So 1.1 will be the adjustment factor for the stock dividend, but that's not the only one. Got another. I had on June 1st, a stock split, a 3-for-1 stock split that took place on June 1st. Now, how do I deal with that? Again, 3-for-1 means for every one share that you had before, you'll now have 3 shares outstanding. So adjustment factor there is 3. And that will get applied because the stock split happened on June 1st. Every date that is before the 1st of June. So January 1st, yes. February 1st, yes. May 1st, yes. October 1st, no. This last one, this last transaction will not be adjusted for the stock split. So October 1st, I'm neither adjusting for the stock split, nor am I adjusting for the stock dividend. So adjustment factor for October 1st will be 1 or 100% if you will. For the May 1st transaction, I'm going to adjust for just the stock split, but not the stock dividend. So just the stock split, the adjustment factor is 3. So adjustment factor for the retirement of shares is 3. Now, February 1st, I have to adjust for the stock split and I've got to adjust for the stock dividend. All right. Now here, the adjustment factor for the stock split is 3. The adjustment factor for the stock dividend is 1.1. So 3 multiplied by 1.1, the total adjustment therefore works out to 3.3. So you want to multiply these. If you have more than one adjustment factors, it's the product. So don't think of it as 3 plus 1.3. Okay, it's not that. It's 3. So first of all, the stock split means I get 3 shares for every 1 share that I owned before. The stock dividend means for every share that I had earlier, I'll have 1.1 share after the stock dividend. So if I've already tripled because of the stock split, then 3 shares, add an extra 10% of that, means I will have 3.3 shares resulting from that transaction. Okay, does that, I want you all to be absolutely sure about this. It looks simple, but sometimes we get confused with these things, and you don't want that happening on the second midterm. So adjustment factor, if you can get this part, then it should be relatively easy. So stock split, I need an adjustment factor for the stock split, and that's 3. My adjustment factor for the stock dividend is 1.1. The total adjustment factor is not 3 plus 1.1, it's 3 multiplied by 1.1. Okay, 3 multiplied by 1.1, and that's 3.3. All right. And same thing for the January 1st, 3.3. Now, fraction of a year, the January 1st, because that's the beginning of the year, that was outstanding for a full year, so 12 out of 12 months. The February 1st transaction, that's outstanding for 11 months. So 11 over 12 or 0.9111, whatever that works out to. Retired shares, that happened on May 1st, so 8 months out of 12. And then the October 1st, that's October, November, December, 3 out of 12 months. Now, if you go ahead and then multiply number of shares, adjustment factor, fraction of the year, you get for the opening balance is 1,914,000, and then the rest, the weighted average number of common shares outstanding is the total, which works out to $2,073,500 shares rather. That's the weighted average number to use for the EPS calculation. Okay. You need the net income available. You need the weighted average shares. After you've calculated both, just divide the dollars by the shares. So EPS is net income available divided by weighted average common shares, $1.21. And that is our basic EPS. Okay. Part B of the question says, assume the same facts as above, except that the preferred shares were cumulative. Now, nothing's declared for the dividends for the preferred shares. But if the preferred shares were cumulative, then we know that doesn't matter if anything is declared or not. You got to subtract 1 year's worth of dividend. Now, 1 year's worth of dividend is 800,000 that we calculated. So in that case, net income available to common will be 2.5 mil minus the $800,000 of preferred dividends. And that's $1.7 million will be available to common shareholders. So preferred dividend, you subtract in this case. Why? Because the preferred shares are cumulative. If they're cumulative, they could have said whatever about how much was declared, right? They could have said $400,000 was declared. You don't care. If it's cumulative, you need to subtract 1 year's dividend. Like, you got to be very, very, very sharp here. Can't allow to get yourself to get confused. All right. So step 2 would be the same as part A. You already know the numbers. So basic EPS in this case will be 1.7 mil divided by 2,073,500 shares. That's 82 cents. All right, and then part C says, assume the same facts as above, except that the net income included a loss from discontinued operations of $200,000, net of applicable income taxes, calculate EPS. Well, here, if the $2.5 million amount is after a loss on discontinued operations of 200,000, the income from continuing operations must be 2.7 million. The number of shares outstanding will be just the same, but because if a company has discontinued operations, you need to report three amounts for EPS: the income from continuing operations, the income from discontinued operations, and the net income. Weighted average common shares is the same as earlier. Divide the dollars by the weighted average and you get EPS amounts: $1.30, 10 cents. Now notice 1.3 minus 0.1, you should be looking at $1.20, but the way it works out, just leave Excel to do the rounding and so on, right? So just don't kind of hand calculate it. There is a bit of rounding happening here. Like if I increase the number of decimal places, that's funny. Oh, that's because I've got round. I put the round function. If I don't round it, right? If I calculate it without the rounding function, the earnings per share on the continuing operations amount would be 1.3021. If I do the math for the, okay, so the loss is 0.0965, net income is 1.2057. But what I did is I put the round function, right? I use the round function to round it to 2 plus decimal places. So let the Excel thingy do it for you, right? Don't, so on an exam, you don't have to use the round function. If I chose not to use the round function and I went with this, well, just make sure that you're only showing 2 decimal places, right? So make sure you reduce the number of decimal places to 2. And if you do the math, you still will get the same outcome. You know, the negative amount showing in brackets and all, that's kind of nice, but that's just formatting. And if you don't, if you don't have the time to do it on an exam, that's okay. Right? That is something that, you can make your worksheets look pretty. You can learn how to make your worksheets look pretty later on. You got to first learn how to do it right. Yeah. So for me, getting it right matters. So please do practice questions later. So Mehak F question says 2 years dividend is an arrear. Then we do. So Mehak, you have to absolutely make sure that you listen to what I'm saying. The question will say a lot of things to confuse you. If the preferred shares are cumulative, close your eyes, disregard everything. You will only subtract 1 year's dividend. It doesn't matter how many years dividends is in arrears, how much was declared, we don't care. 1 year, that's all. If it's cumulative, 1 year. If it is not cumulative, then you look at the amount that was declared during the year. That is what you got to be very sharp focused on. The questions will confuse you many different ways. Okay. Anything else? Okay, hearing none, let's move on to diluted EPS. Now the diluted EPS is the fun part here, and it can get pretty ugly if we are not like it'll be the bulk of the marks. So on an exam question, just the relative weighting, you will get a question. And you will get a question that asks you to calculate diluted EPS, right? I'm guaranteeing you that, so that you can learn. At least looking forward to that exam, you'd say, okay, I know there's going to be a diluted EPS question. And in order to calculate diluted EPS, your first step is to calculate basic EPS, right? So that means if I'm asking you to calculate diluted EPS, you need to know how to calculate basic EPS, the one that you just looked at. In terms of the mark split, though, the basic EPS component doesn't count for a lot of marks. At most, it'll be maybe like if it's a 10-mark question, the basic EPS calculation will just be a couple of marks. The rest is all the work that you have to do for diluted EPS. So please make sure that you have your eyes and ears open if you disregard this. And that seems like what happened to a few individuals on the exam. They kind of like just said, okay, I don't quite understand this, but I'm not going to ask any questions. And oh, good Lord, those topics show up on the exam, and we found just like not having an idea, right? That's how it was. Like the low marks are not because people made a lot of errors. The low marks are because people left a lot of the questions not attempted, or when they were attempting them, they had no idea of what to do. So this piece you really have to own. If you can own it, there's lots of questions to practice from the textbook. Trust me, you do the work. There's no power on this earth that can stop you from getting 100% on this particular question. Okay, it's very, very, very straightforward. Hard, but straightforward. I don't know. Okay, diluted EPS. It's a hypothetical. So it's not an indicator. It's not an amount that's actually happened. It's a make-believe. Hypothetical is make-believe, right? For the sake of discussion. It's a hypothetical indicator of what the lowest earnings per share would be. And why would EPS go down? Well, what can make EPS go down? There's two reasons. One, your net income goes down. We're talking about diluted EPS for the current year. So we already know what the net income is, right? So it's unlikely that number would go down, right? In the future, like, yeah, sure, the future net income goes down. If in the future net income goes down, then basic EPS will be lower as well. There's nothing to do with the diluted part. So if you're thinking about diluted EPS, you got to think the only reason why the earnings per share number would go down is if you had more common shares in the denominator. And more common shares, well, why would there be more common shares, right? There can be stock dividends, stock splits, sure, but then that would be captured in the basic EPS. So what's unique about the diluted EPS? So this is ignoring any possibility of stock dividends and stock splits. We're putting that aside. We're saying, what if we have some complex financial instruments like convertible bonds, or we have stock warrants, or we have convertible preferred shares, or we have stock options? Well, if the convertible bonds are converted into common shares, that's going to result in more common shares, right? If you have more common shares, it's kind of like, in olden times, right? If you had a family of 4 and there was, let's say, a pizza, you cut up the pizza into 4 slices, large slices, but basically that's what people ate. If you had an extra member coming in, 5 people, same pizza, now everybody gets smaller slice, right? That's basically the idea here, that if you have more common shares outstanding and there's nothing like keeping the same net income number, well, not exactly same, but just for the sake of argument here, you had, for the net income that we have, if it was to be spread over more common shareholders, what would that earnings be for every share? And you're basically trying to portray the worst case scenario. It is important, the worst case scenario, okay? Diluted EPS represents the worst case scenario of what would happen if you had a whole bunch of potentially dilutive securities coming into play. Potentially dilutive means they will result in more common shares being issued, a greater effect on the number of shares outstanding than a beneficial effect on the net income. Okay, so in that calculation, what we do is, all right, if you have convertible debt, right, if I have convertible bonds, if the bonds get converted into common shares, well, there's two things that's going to happen. One, the bond liability will be replaced by number of common shares. I'm going to have more common shares outstanding. But there's also the fact that the bond liability, see, on the bond liability, I had interest expense. Interest expense, everything else being equal, interest expense reduces my earnings before tax, right? Which means it also reduces net income. So if I converted the bonds into shares going forward, I would not have to pay the interest, right? There would be savings on account of the interest expense. So that is going to make the net income number go higher. All right, so numerator of the calculation will be net income available to common, which we use for the basic EPS calculation. And then we add the income effect of the dilutive common share. And I'll get into the more details in a bit, but you just kind of got to understand that if I have any potentially diluted security, right, these I need to look at the income effect of the conversion. And in the denominator, I'm going to need to add the share effect of the dilutive common shares to the weighted average common share. Now, when I divide the numerator by the denominator, in this case, if the dollar amount that I get is lower than the previously calculated EPS, then it's dilutive. If it's not, then there is no dilution. Now, you will understand it better when I do the numerical example, but I want to point out one thing again. Watch out. It's mostly like a cerebral thing. It's a conceptual thing. If a company's already got a loss, right? So think about it. If a company has a loss of $100,000, it's got 100,000 shares outstanding. Its basic EPS will be a loss of $1. 100,000 loss divided by 100,000 shares, you get a loss of $1. Now, if let's say the company had convertible, let's say the company has some options, stock options. Now, stock options, if they are exercised, they will result in more shares being issued, but there's no effect on the income. Without complicating things, let me just say the company has a lot of stock options outstanding, which can result in an extra 100,000 shares being issued. So what's that going to do? The denominator will be 100,000 weighted average common shares that we have right now, plus another 100,000 possibly coming from the stock options. So what that would mean is now you'll have a denominator of 200,000. Your loss was 100,000. So if you calculate what the EPS would be now, it'll be loss of 100,000 divided by 200,000 common shares. That will be equal to a loss of 50 cents. Now, it's half the loss. If your basic EPS was $1, after taking into account the consequences of conversion or the exercise of the options, your EPS actually gets better. A loss of 50 cents. See, a profit of 50 cents is less than a profit of $1. But a loss of 50 cents is actually higher, better than a loss of $1. So whenever a company has a loss, basic EPS is the diluted EPS. It's a conceptual thing. So on an exam, I could just throw you that like a little bit of piece of information. What happens in that case? Well, if your basic EPS is a loss, you don't have to go any further. Basic EPS, if your basic earnings per share is a loss amount, that is the diluted EPS. Okay. All right. So what are the possible dilutive securities that you'll come across? For this course, you are responsible for knowing about convertible debt. So convertible debt, if you have convertible debt, examples are basically convertible bonds. The income effect will be the after-tax interest expense. Now, interest, because interest is a deductible for tax purposes, interest expense reduces income before taxes, but it also therefore flows through onto the lower income tax expense as well. So when a company is considering the calculation of diluted EPS, you want to take into account, you want to add the income effect will be the interest expense that will be saved if the bonds are converted, but you got to make sure that you can do the calculation on an after-tax basis. So say if a company's tax rate is 30%, then you basically will multiply the interest that you can save by 1 minus 30%, that's 70%, right? You'll be able to save 70% of the interest expense as an increase, as a bump up to your income. The share effect will be the number of common shares that would be issued when the debt is converted. For convertible preferred shares, you look at the dividend, right? Because if the preferred shares are converted into common, you won't have to pay dividends on the preferred shares. And there, just like we did the math for net income available to common, it depends whether the preferred shares are cumulative or not. If the preferred shares are cumulative, you will take into account 1 year's dividend. If the preferreds are non-cumulative, you will only take into account whatever dividends been declared during the year on them. And please keep in mind that dividends are distributions from retained earnings. You do not do an after-tax calculation on this. Interest on the bonds, you do an after-tax calculation. On the dividends, there is no after-tax calculation. These are common areas where people make mistakes, so I'm pointing them out. Okay, be very careful with this. Dividends, there is no tax effect. Interest, there is a tax effect to take into consideration. And then you could be looking at options. Now, companies can have call options or they can have put options. A call option, basically, if the company wrote a call option, it basically allows the option holder the ability to buy a certain number of common shares of the company for a specified exercise price, right? We learned about options in chapter 16, the complex financial instruments chapter. And these options are said to be in the money, right? In the money is a phrase used where, so if the call option has a strike price of $10, right? The option holder can buy 1 share of the company for $10. Now, the option holder will be in a position to make money if the company's stock price is more than $10, right? If my exercise price is $10, let's say the company's stock price is $15. Well, then if I was to exercise my option, I can get the company to sell me 1 common share for $10, and then I can sell that common share on the open market for $15, and I'll make money, right? So that's the idea. Now, whether the option holders actually exercised or not, the whole idea here is that none of these conversions, etc., have actually taken place. It is a what if calculation. Suppose they had converted, right? Suppose they had exercised the options. Well, the call option holder, there is no reasonable reason, there is no rational sense for them to exercise their option if they're not in the money, right? If the company stock price is less than $10, why would the option holder go to the company and say, I want to buy your shares for $10? They can easily buy them for less on the stock market. So they have to be in the money. And to be in the money, call options, the exercise price must be lower than the average market price. Now we want to use average market price. Sometimes in questions, they'll give you different market price information. They might say the stock price at the end of the year was so many dollars. The average during the year was so many dollars. You want to take the average price because earnings per share reflects earnings that took place over the year. So during the year, whatever was the average price for the company's stock, if that average price was more than the exercise price, then the options are said to be in the money. If they're in the money, they were potentially dilutive. Now, the thing with options is if the options so we're not paying anything, right? The company currently doesn't pay any dividends to the options, right? The company doesn't pay any interest on the options. So if the options get exercised, they will have zero effect on the income, right? There is no income effect for options, but there will be a share effect. And we use something called the treasury method. Okay, the calculation, I'm not going to get into too many intricacies here about the explanation. I will try to give you a basic explanation when I do an example, but the basic math is the share effect is calculated by multiplying how many options were outstanding that were in the money, multiplied by the difference between the average market price and the exercise price over the average market price. Okay, so I'll just leave it at that for now. I'll try to explain when we're dealing with numbers, but that's the math. Now, companies can also have put options. A put option is just the opposite of a call option. So under a put option, the holder of the put option can force the company to buy back its shares at a fixed price. All right, call option, the option holder can buy the shares from the company at a fixed price. Put option, the option holder can sell a share to the company at a fixed price. Now, I hope your stocks, if you own stocks, they've been doing okay. You know, lately the stock market has been going mental. So a lot of stocks have fallen, right? So somebody that has put options under these circumstances, they could be in the money. For example, you know, someone can have a put option on a company for $50, right? So basically having a put option for $50 means that person can require the company to buy back each share from them at $50. If the current market price of the company shares is $40, then that option holder is in the money, right? They can basically, you know, like they may not own the shares. So all they have to do is go and buy a share from the market at 40, go to the company and say, hey, company, I have a put option at 50. Here's the share, buy it back from me and pay me 50. They can make $10 difference as a profit. So for put options to be in the money, these situations just got to be the opposite of a call option. The exercise price needs to be higher than the average market price. So if that is the case, still with the options, there's never any income effect. It's always only the share effect, right? So options are always dilutive and the calculation will just be very similar to the call option. You just switch, right? So you switch, you take the difference between the exercise price and the market price divided by the market price. And that's called the reverse treasury stock method. So how do we go about calculating diluted EPS? First step is to calculate basic earnings per share. Basic earnings per share, as you know, you got to take the net income available to common shareholders, got to take the weighted average common shares outstanding, divide the two, you get basic EPS. Then you got to look at the information given, and any standard exam question will have 3, 4 potentially dilutive securities, sometimes even more, right? Sometimes they might even have certain securities that are not dilutive, right? And they just throw in there for good fun. Okay, so 4 is sort of an average. There can be more than 4. 3 would be the lower end. Like, you very rarely will you get an exam question that only has 1 or 2 dilutive securities. So they will have 3 to 4. And then what you got to do is you got to calculate the individual earnings per share for each of these potentially dilutive security. And again, a reminder, what's potential dilutive securities? Could be convertible bonds, convertible preferred shares. And keep in mind, a company can have more than one type of bonds. The company can have more than one type of convertible preferred shares, right? So I don't have to come up with every specific variety, but usually what you should expect is there would be an option, there would be a convertible bond, then there'll be a convertible preferred shares. Like, if you are prepared for all 3, you'll be in a good space, right? So you got to calculate the individual earnings per share for each of the potentially dilutive security. Now, the determination of whether a security, whether any of those is dilutive or not, is based on comparing the individual earnings per share. And the individual earnings per share is basically calculated by dividing the income effect by the share effect, right? The income effect number, that's the dollars. The share effect number, that's how many additional common shares will be issued if that particular conversion occurred or the exercise occurred. So income effect divided by the share effect gives you the individual EPS. And maybe I should just put that. Individual EPS is income effect divided by income effect divided by share effect. All right, so you got to calculate individual EPS. If the individual earnings per share is less than the basic earnings per share that you calculated, then the security is potentially dilutive. All right, so you first need to figure out which of the securities are potentially dilutive. Usual exam question, you'll have 2, 3 potentially dilutive. Okay, now if you have, certainly if you only have 1, then that's about it. But if you have more than 1, right, you have 2, 3 potentially dilutive securities, what you want to do is you want to rank. And this is one step that I find students often skip, and then they regret because they end up making a mistake. So you don't want to skip this step. Please make sure all the practice that you do, and you should do practice questions from this chapter. When you're doing practice questions from this chapter, do the questions more about the problems, right? Because those are the ones that have the more juicy, meaty examples. Make sure that you're not skipping the step of ranking each security. And when you're ranking, you start with the most dilutive. Most dilutive means it's got the smallest individual EPS. And there's nothing smaller than 0. So options, because they have no income effect, the individual EPS on options is 0, right? So options will always be dilutive, provided our basic earnings per share is a positive number. If the basic EPS is a loss, you know there is no other possibility of dilution. The basic EPS, if the EPS is a loss to begin with, that is diluted EPS. All right, so I mean, I can write an exam question where the basic EPS ends up being a loss. That's it. Then you don't have to worry about looking at anything else. I could still say, regardless of your basic EPS, still calculate the individual EPS, etc., just to make sure everybody does it and you get marks for it. But just keep in mind, if your basic EPS is a loss, that's the diluted EPS. But if your basic EPS is a profit amount, then you want to compare the individual EPS to the basic EPS, and any of the options that are in the money, they will always be diluted because they have zero income effect. So their individual earnings per share is zero. Okay. The others, it depends. They may be dilutive, they may not. Okay, so that is a very important step. And then the third step is to do the actual math. And the math is done by, you start with basic earnings per share, and then you include each individually potentially dilutive security that you calculated, right? Each of the potentially dilutive securities from step 2, you will include them in the math one by one, starting from the most dilutive, right? One by one, and it's an iterative process. You will keep calculating the earnings per share resulting from including the potentially dilutive security, right? You keep calculating and see, is my earnings per share number going smaller, 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 smaller? So as long as the earnings per share keeps reducing, keep going. If you hit, and that's one possible last curveball, folks, please make sure it is possible that you have an individual earnings per share that was lower than the original basic EPS. But remember, you'll be including a lot of these securities into the math, and that's going to keep driving your earnings per share number. It is possible that an individual security was originally found to be dilutive, but when you do the iterative math, you could hit a point where that security is no longer dilutive. You got to stop the calculation at the point when you have hit the smallest amount for the diluted EPS. The diluted EPS, remember, is the worst case scenario. You got to stop at the point where you get the smallest dollar figure. Now, I don't have an example of that in tonight's class lecture. I'll see if I can find an example, and maybe I'll post that as an extra practice question. But even if I don't, it's something that you need to keep in mind, that it is vital to have the listing, the ranking of the potentially dilutive securities from step 1, because that is the sequence in which you're going to include them in your math. And that is a potential area where people might get stumped on an exam question because they just did not pay attention. And right, because you can have a situation where there's a reversal that happens. The EPS number actually goes up because the individual earnings per share effect of that particular security happens to be higher than the current diluted EPS calculation. I know that's maybe sounds a lot confusing because it's a lot of words without looking at numbers, but I don't have a, maybe I'll cook up an example while I walk you through, but keep an eye for that. And so that brings us to the last slide, which is the examples that we're going to work on, problem 1710 and problem 1712. So first doing, 17, sorry, I've got 1712 and 17.4. So 17.4 and 17.10. So 1712 is the example that I'm going to do first. Okay, and this is kind of like a possible exam question, right? Possible exam question, because it's got a lot of these potential dilutive securities, etc., that I was mentioning. Okay, not to say that this is exactly what you should expect, but it's kind of like, you know, in that area. And I will try to find a good question for practice that actually has that, your EPS number actually goes the other way if you keep going, right? I'll try to find, I'm sure I have an old question somewhere. Okay, so we're given information for Polo Limited for 2020, net income for the year 2.3 mil. It's got $2 million of 8% convertible bonds, $4 million of 6% convertible preferred shares, $6 million of common shares, $750,000 worth of stock options. So that's the contributed surplus stock options. Tax rate for the year is 30%. The average market price per common share is $25. Now, I didn't read any of the details provided. I just need to skim through what the information is, and then we'll come back to take a look at what the details are in a bit. There were no changes during 2020 in the number of common shares, preferred shares, or convertible bonds outstanding. For simplicity, ignore the requirement to book the convertible bonds equity portion separately. Remember that we have to split the convertible bonds into a bond portion and contributed surplus. So they're saying just to keep things simple, let's just ignore that for a bit. They said first calculate basic EPS and then do a diluted EPS calculation. All right, so basic EPS, earnings per share. We're going to look at net income available to common. Now, net income for the year is 2.3 million, but the company has preferred shares. It's got 6% convertible cumulative preferred shares. Cumulative. The moment I see the word cumulative, I know I have to subtract 1 year's dividend. What is the dividend? Well, each preferred share has got a $100 par value and the dividend is 6%. So 6% of $100 is $6. Each preferred share gets $6 of dividend. Now, how many preferred shares are there? The total dollar amount that's showing up is 4 million. Each preferred share has a par value of $100. So how many shares are there? 4 million divided by 100, that's 40,000 shares. Each share is paid a dividend of $6. So what is 1 year's dividend? 40,000 shares times 6, 240,000. Okay, so total par value per share, number of shares, dividend per share, total dividend. Now, I don't care if any dividend was declared or not, because the preferred shares are cumulative. I have to subtract 1 year's dividend from the net income. So net income is 2,300,000. 1 year's dividend is 240,000. I have to subtract that out to get net income available to common, 2,060,000. All right. Now, they kept it simple in this question. An exam question could give you a little bit more about, oh, there were some extra shares issued, some shares were retired, and that can sort of require a calculation of weighted average common shares, right? So be prepared for that part. Here, they kept it simple. I picked up a simple example because you need to first learn the basics, and then when you practice at home, do practice. There are other more involved questions from the textbook that you should look at as well to gain a better understanding of the material. All right, so number of shares outstanding is 600,000. There was no changes during the year. So 600,000 is the number of common shares outstanding. So that's given. If I calculate basic earnings per share, it'll be 2,060,000 divided by 600,000. And basic EPS is $3.43. That's the first step to calculating diluted EPS. We all okay with that? Yes, Kyle. It'll be easier if you just unmuted yourself and spoke.
Hi. So for the preferred dividend, like it's 6% convertible, but you have it as 6. The dividend per share as 6. Would
So
that not be a percentage, or you just have it as a?
Oh yeah, so it is a percentage. So you could just multiply 6% of 4 million gives you 240,000.
Okay.
Right. So yeah, I mean, that's probably the quicker way of doing the math. I just wanted to show how many shares, etc., so that people
Right.
could follow it through. But yeah, 6% of 4 million gives you 240.
Okay. Because yeah, I was just looking at like how you, because I believe you, let's see here.
So
Yeah,
how
'cause
did
you
I
just
calculate?
had number of shares by 6. Okay, yeah,
Yeah, so it's each share's got $100 par value.
Mhm.
So every share gets $6 in dividend.
Right. Okay, makes sense. Thank you.
All right. Okay, so once you've done step 1, step 2 is to determine the potentially dilutive securities. And if I just go through the laundry list, it starts out with the convertible bonds, right? So if you have convertible bonds, you got to take them into consideration. So what about the convertible bonds here? These are 8%. So 8% is the interest rate on the bonds. The face value, so you can calculate the interest pretty easy. 2 million times 8%, right? They're issued at par. So 2 million times 8%, 2 million, 8%. If I multiply 8% by 2 million, I get $160,000. But remember, when I'm talking about interest expense is deductible for tax, which means I get to save some tax. So if these bonds were to get converted, I'll be able to avoid the interest expense, but the impact on net income is not going to be $160,000 saved. My saving needs to be on an after-tax basis. So I've got a tax rate of 30%. If my income before tax is $1, for every dollar of income before tax, I got to put aside 30 cents in taxes. So my net income works out to 70 cents, right? For every dollar of before tax income, my net income, the after tax net income is 70 cents. So if my interest that I pay on the bonds is 160,000, net of taxes, that is only 70% because I've got a 30% tax rate. Out of 100, if you remove 30 for taxes, you're left with 70%, right? So my after-tax interest is 70% of 160,000. That's 112,000. So like if we converted these bonds, we have not converted the bonds. So remember, diluted EPS is a hypothetical, make believe, let's pretend type situation. So if these bonds were converted, we will be able to save $112,000 in after-tax interest. So if you save on the interest expense, what happens to net income? Goes up, right? So I've got an income effect of $112,000. So 8% convertible bonds, income effect is 112,000. So the calculation is 8% of 2 million times 1 minus the tax rate, 112,000. So if these bonds got converted, I will save $112,000 in after-tax interest costs. That's the income effect. Well, how many shares will I end up issuing? The information given is each bond is convertible into 30 common shares. Well, how many bonds are there? Each bond is $1,000. They were all issued at par. So when I look at 2 million, well, how many bonds do I got? If the total face value is 2 million, if you divide 2 million by 1,000, you get 2,000 bonds, right? There's a total of 2,000 bonds. And each bond can be converted into 30 common shares. So total number of shares that I'll have to issue, 2,000 bonds, 30 shares each, 2,000 times 30,000, 2,000 times 30 rather, that'll give you 60,000 shares. So share effect of the bonds is number of bonds multiplied by 30, and that's 60,000 shares. Now, what is the individual EPS of the bonds? $112,000, that's the income effect. 60,000 is the share effect. So dividing 112,000 by 60,000, I get earnings per share $1.87. Income effect 112,000, share effect 60,000, divide the income effect by the share effect, you get $1.87. Is this calculation understood? All right. Is it dilutive? Now, how do I decide if it's dilutive? I got to compare the individual earnings per share to the basic EPS, right? The company's basic earnings per share is $3.43. As long as the individual EPS is less than $3.43, you say it is dilutive, right? This security is dilutive. So the bonds are dilutive. Now, what sequence am I going to introduce the bonds? That depends on the ranking, which I can't do just yet. I got to wait until I've gone through all the lists, right? So bonds, they are dilutive, potentially. Okay, similar thought process. You go to the next one, convertible preferred shares. All right, so these are cumulative. So you gotta, if these bonds, if these preferred shares were converted during the year, we would have been able to save $240,000 of preferred dividend. And dividends, remember, there's no after-tax calculation because dividends is paid out of retained earnings. There is no tax deductibility of dividends in Canada. So the dividend amount, there is no net of tax calculation there. If these preferred shares were converted, we would have been able to save $240,000 of dividend. So 6% of 4 million, 240,000. That's the income effect. What's the share effect? Well, you got to look at how many shares would have to be issued. And that's where I was alluding to. You're looking at 40,000 preferred shares right now. And each preferred share is convertible into 3 common shares. I got 40,000 preferred shares. If each preferred share can get 3 common shares, the total number of common shares that would be issued if the preferred shares were converted is 120,000. So 40,000 shares multiplied by 3 shares each, that's 120. And the math is pretty simple. 240,000 divided by 120 gives you individual EPS of $2. Is it dilutive? Well, is $2 less than $3.43? The answer is yes, it is dilutive. And certainly if I had to just do the ranking between the bonds and the shares, the bonds are more dilutive than the preferred. Now this may seem counterintuitive, but I'm saying more dilutive. I'm saying the one that has the smaller individual EPS. The bonds individual EPS is smaller than the preferreds. So if these were the only 2 securities, I would say bonds first, then the preferreds. But wait, we got more, right? We've got other securities. So don't just stop there, keep going. Common shares, that's fine. Okay, I got stock options. All right, stock options granted to purchase 75,000 common shares at $20 a share. $20 a share, that's the exercise price. Are these options in the money? To answer that question, I need to look at what was the average market price during the year. Now, in this question, they only gave us the average market price. In other questions, they'll confuse us. They'll say average price, so many dollars. The market price at the end of the year was so many dollars. Now, if you're not very sure, you'll get confused and you might end up picking the wrong number. To determine if the stock options are in the money, you want to compare the exercise price to the average market price, please. Average price. Average price is $25. So are the options in the money? Because these are call options, as long as the exercise price is less than the average market price, the option holders could have made money by exercising their options, buying shares from $20 from the company and selling them out at $25 each, right? So they could have made some money there. So yes, they were in the money, which means the call options were dilutive, and we have to consider. Now, the income effect for the options is always $0. So income effect for the stock options, 0. Now, what's the share effect? For the share effect, remember, you got to look at the number of options. So what's the number of options here? In our example, the number of options is 75,000, right? Stock options to purchase 75,000 common shares. So number of options, 75,000 multiplied by, now, the difference between the market price and the exercise price. So we've got the numbers here. Exercise price is $20. Market price is $25. So the difference between the two is $5. Okay, so 5 divided by, and it's always you're going to divide by the market price. So market price is 25. So 5 divided by 25, that fraction is multiplied by the number of options. So 75,000 options times 5 over 25. And how did I get the 5? It's $25 average market price minus $20 strike price. So this math will work out to 15,000 common shares. And 0 divided by 15,000 is 0. Is it dilutive? Of course, right? Stock options will always be dilutive under these circumstances. Written stock options, as long as they're in the money, it is going to be dilutive. And so that is dilutive. So I've got 3 securities, they're all dilutive. Which one is the most dilutive? That's my stock options, hands down, right? $0 beats everything. The next in terms of having a low EPS is bonds. So bonds will be ranked second, and convertible preferred shares will be ranked third. So first bonds, second convertible, first stock options, second convertible bonds, third convertible preferreds. All right, Lisa has posted a question. If something is not dilutive, yeah, you just leave it. You don't have to calculate the income effect, etc. Like if you can tell that it's so if the options were not in the money, there's no point even in doing any math, right? They're not in the money, they're not in the picture. But sometimes you only find out whether something is dilutive or not after having looked at the income effect and the share effect. So if it is not dilutive, you'll say it's not dilutive. You're not going to consider it in the diluted EPS. All right, so we figured out, we've ranked. Now it's the time to calculate diluted EPS. Start with basic earnings per share. We already did that math in part A there. So basic EPS is $3.43. Now, you're going to first introduce the stock options. So stock options, they bring with them $0 to net income, right? Nothing is added back to net income for the stock options, but they are going to result in 15,000 shares. And I know I said I'll explain what that 15,000 means. I will, but for now, assume that the share effect is 15,000. And if that's the case, after we introduce the stock options into the play, what are we going to be left with? Our net income available to common shareholders will be 2,060,000. It's going to stay 2,060,000. But the weighted average common shares number is going to go up from 600,000 to 615. Now, if I calculate earnings per share using these amounts, 2,060,000 divided by 615,000 shares, my dollar per share number works out to $3.35. Look at $3.43 that it was earlier. Has the number gone down? Yes. Okay, so it is getting diluted, right? Diluted EPS, remember, it's the worst case scenario. You're trying to report the lowest amount of EPS that is possible if all of these potential common shares materialized. So this one, okay, keep going to the next one. Next one is my 8% convertible bonds. So for my 8% convertible bonds, if I converted the bonds I'll be able to save $112,000 in interest expense. So that will cause my net income, right? My income available to common shares to go up by 112,000. So from 2,060,000, my income available to common shares will go up to 2,172,000. But I'll also have 60,000 new shares issued. So that's going to make my weighted average common shares go up to 675,000. So what is my EPS now? The 2,172,000, divide that by 675,000, I get $3.22, which is less than 335. So it's still getting diluted. All right. So that's splendid. Go on to the next one, which is my convertible preferreds. And if I did have my convertible preferreds going through, my convertible preferreds will result in, if the preferred shares got converted, we would no longer have to pay the preferred dividend. That means the income available to common, remember, income available to common is net income minus the preferred dividend. If there was no preferred dividend, all of that income would have belonged to the common shareholders, right? So this will result in $240,000 more of income to the common shareholders. So total net income available will become 2,412,000. Weighted average common shares will go up by 120,000. So from 675, they'll become 795,000. Divide the 2,412,000 by 795, and we get $3.03. Now that is hands down the smallest amount of earnings per share, and therefore is our diluted earnings per share. Any questions? Yes, Tony.
Yeah, I have a question here. So for example, if for the 8% convertible bonds, we calculate EPS as say like 3.5, are we still continue with 6% convertible preferred shares in that situation?
So, okay, I hear you. So you will stop the moment so this number I'm calculating iteratively, right? I first brought in the stock options, did the math. Then I got the convertible bonds, did the math. So if let's say here at the 8% convertible stage, let's say if this number ended up being more than $3.35, suppose if it was,
Okay.
then you've kind of moved back into the opposite direction. That's not right, because the preferred shares would only come into play after the bonds have been taken. That's why this ranking is so darned important, right? If we mess up in the ranking, then things are not going to play out for us. So ranking is very important. So if we have made sure here that our ranking is fine, and then for whatever reason, if this number, now I introduce the 8% bonds and I'm looking at $3.36, well, 336 is more than 335. So diluted EPS, therefore, will be $3.35. You don't even need to move forward. The moment your EPS number stops decreasing, like if it turns the tide, if it goes up, that's your diluted EPS.
Okay. So,
right. So it is. So as I was saying, I don't have any example for tonight, and I don't know if there's any textbook example that has that, but it is something that on exams shows up. And I would want you to be prepared for that. So, you're expected to do the individual EPS calculation, do the ranking. If you skip the ranking, there's no marks for the ranking, right? So sometimes people say, oh, if there's no marks, I'm not going to do the ranking. Hey, it only takes 30 seconds to do the ranking. But if you don't do that, then you will possibly suffer consequences.
Okay. Thank you.
Otherwise, okay? All right, 17.4. This one is a little more complicated, but it ends up being a lot easier. So it's kind of like a non-event type question, right? Like, I mean, you at first glance, it looks like, oh, such a long question, but really there's not a lot happening here. So I figured I'll show this just to show that, you know, you look at a question and you go, oh my God, there's so many things happening. I'm sure it's going to be tough. And it's not really a tough question. So Audrey Inc. has 1 million common shares outstanding as at Jan 1st, 2020. On June 30th, 2020, 4% convertible bonds were converted into 100,000 additional shares. Up to that point, the bonds had paid interest of $250,000 after tax. Net income for the year is $1,298,678. During the year, the company issued the following. So June 30th, 10,000 call options giving holders, okay, 10,000 call options. September 30th, 15,000 put options, right? On February 1st, Audrey purchased in the open market 10,000 call options of its own shares. All right, we'll come back to that. The average market price for the shares during the year was $35. And that's useful information, $35. Okay, let's go back, take a look. 10,000 call options gives the holders the right to purchase shares of the company for $30. So exercise price, $30. Average market price, $35. Were these call options in the money? Huh? So call options are in the money if the exercise price is less than the market price. So think of it, if I can buy a share from the company for $30, but the market price is 35, I'll be getting myself a good deal here, right? I would make some, I'll be better off using the option. So think of it that way, right? If the market price is 35 and I can get a share from the company for 30, I'm benefiting for the difference. So that's what makes them in the money. So these call options, they will be dilutive when we do the diluted EPS calculation. What about the put options? Put options allow holders to sell shares of the company for $25. So again, think about it. The market price is $35. And these put option holders can make the company buy back its shares for 25. Do you think these put option holders are in the money? No, because I mean, if I want to sell my share, I'm better off selling on the market rather than sell the share back to the company for $25, right? It doesn't make sense to exercise the put option. So for put options, exercise price has to be higher than the market price, just the opposite of the call. So if you can remember what happens with the call options, for put options, you do just the opposite and you'll be good. Okay, so otherwise it makes it a little bit harder to remember everything. So try and remember the call options. Call options, you want the exercise price to be less than the market price, average market price. What about this one? Audrey purchased in the open market 10,000 call options, allowing it to buy its own shares for $27. Now, if the company can buy back its own shares for $27, it's going to make a profit, right? The average market price is $35. So this one's not dilutive, because when you buy back your shares, the total number of shares goes down, right? The denominator is going to go down, right? So if a company buys call options, that's not dilutive. Okay, so leave that aside. This is a kind of a red herring. Okay, so let me just type out here. Average market price is $35 over here. Since exercise price is less than average market price, in the money, right? So that's dilutive. For the put options, since exercise price is less than average market price, not in the money. So if they're not in the money, they're not potentially dilutive. You don't even need to worry about them. All right. The purchased call options, never dilutive. So you don't even have to worry about doing any math. It's just a conceptual piece they threw in. So this is more like a red herring, puts us on the wrong track, right? To confuse us. September 30th, 200,000 convertible preferred shares were redeemed. If they had been converted, so redeemed means what? We paid cash, right? So there's no more convertible preferred shares, right? We bought them back. If they had been, so even if something like this happens, so we have to report what the worst case scenario would have been. So these shares were redeemed on September 30th. So for 9 months, from January 1st to September 30th, for 9 months of the year, these convertible preferred shares were outstanding. They could have been converted into common shares, right? So it's like a hypothetical, right? So we could have converted the preferred shares into common shares, and that would have had consequences. That would have had an income effect. That would have had a share effect. So you got to consider these, right? You have to take these into account, right? If they had been converted, these shares would have resulted in an additional 100,000 common shares being issued. These shares carried a dividend rate of $3 a share to be paid on September 30th. No conversions have ever occurred. So there has never been any conversion, and the preferred shares had a dividend of $3 a share that was paid on September 30th. Okay, so this we will have to consider. It is a potentially dilutive security. So need to consider potential dilution for Jan 1st to September 30th. Now, similarly over here, right at the top, 4% convertible bonds were converted on June 30th. So we have to consider potential dilution for Jan 1st to June 30th. So they actually were converted on June 30th, but between January 1st and June 30th, they could have been converted. So diluted EPS impact from Jan 1st to June 30th, actual conversion impact on basic EPS. You got to include in WACS, in the weighted average common shares. So this one's a little bit complex, right? As you can see, there's a few things happening. Just the convertible bonds are going to affect the basic EPS calculation because they actually did get converted and actually common shares were issued for them. But while they were not yet converted, they had the potential of being converted and impacting EPS. And lastly, there are 10,000 5% convertible bonds outstanding with a conversion rate of 3 common shares for each bond starting Jan 1st, 2021. Beginning Jan 1st, 2024, the conversion rate is 6 common shares per bond. And beginning Jan 1st, 2028, it is 9 common shares for each bond. So this is an example of where the conversion ratio changes, right? You can have 3 common shares for each bond now, goes up to 6 common shares for each bond later, goes even higher to 9 common shares per bond. When we are trying to report the possible worst scenario, you got to take the worst possible outcome, right? So worst possible outcome is 9 common shares per bond. So even though the 9 common shares per bond scenario is not going to happen until 2028, you want any any person that is looking to invest in the company now, right, looking to buy its common shares now, they need to be aware. It's kind of like, if you were buying a house near Stony Trail, right, where Stony Trail was getting constructed, it's like buyer beware. Like, you need to do your due diligence, etc. And a colleague of mine bought a house very close to where Stony is, right? So he, I don't know how much of due diligence he put through, or his real estate agents put through, but basically the thing is, if you make an investment without being aware of what's coming, then you're potentially caught with a lemon, right? Usually there needs to be more. Now, in our society, people are litigious, right? So the person that invests, they would say, well, I didn't know you guys were gonna jack up the conversion ratio for the bonds by so much in 2028. So the best way for the company to respond to that is to acknowledge that the worst possible outcome for a common shareholder would be this huge number of common shares potentially issuable if these bonds get converted. And so what if all of these bonds were converted into, at the worst possible outcome of 9 shares per bond? Well, how many more common shares would be there, and what would their impact have been on the current year's EPS? So Mr. Potential Investor, make your mind not just by looking at the basic earnings per share number, make your mind looking at the diluted EPS number, because that's telling you where the future might be, right? Or what our future might be. This has not happened, the conversion hasn't happened, but it can happen, and that will cause a huge influx of common shares. So you'll recall a few weeks ago, I was talking about Western Resources Group. Well, that company essentially could not keep paying interest, and a lot of the bonds got converted into common shares, and from 50, 60 cents per share, the current stock price is 4.5 cents, right? It had gone all the way down to 2 cents per share, because suddenly you have billions of new shares being issued because the bonds got converted into common shares. So this is very, very important for people. If you make investments and you are going through the financials, don't just look at the basic EPS, look also for diluted EPS, because that's the number really you should be paying attention to. All right, so I've kind of talked about it, and I know we are almost out with the time. So basic EPS is pretty straightforward. We did have the preferreds outstanding during the year, right? They got converted, they got redeemed on September 30th. But we did have them outstanding until then, right? So when we calculate the basic EPS, the amount of net income available to common shareholders, the net income is 1,298,000. The preferred dividend is 600,000. Now, how do we get 600,000? There were 200,000 convertible preferreds. We paid them a dividend of $3 per share on September 30th. So 200,000 times 3, that's 600,000. Subtracting 600,000 from the net income leaves us with net income available to common shareholders, 698,678. And then you want to divide that by weighted average common shares. Now, what about the weighted average common shares? The company started with 1 million common shares on Jan 1st. So opening balance, 1 million shares. There's no stock dividend, stock split. So adjustment factor is 1 fraction of the year, 12/12. And then June 1st, sorry, it's June 30th. So my bad, June 30th is when convertible bonds were converted into 100,000 additional shares. So 100,000 extra shares were issued on June 30th. Adjustment factor is 1 because there's no stock dividend, stock split. The fraction of the year, though, is from June 30th to the end of the year. So that's 6 months out of 12. So 6 out of 12. And if I multiply that out, I get 50,000. So 1 million plus 50,000 gives me VASO of 1,050,000 shares. And that's what I divide the income available to common by to get earnings per share, basic earnings per share, 67 cents. All right, basic EPS, 67 cents. And then just to pick up a little bit of pace here for the call options, they were in the money as I explained. So income effect is 0, as we know. The share effect is there's 10,000 call options. Multiply that by the difference between the average market price and the exercise price. So 35 minus 30 divided by 35. Now, because these options were issued on June 30th, they weren't really outstanding for the whole year. They were issued on June 30th. So these options were outstanding for half a year. You got a prorate for that, right? Prorate for the 6 months. And so that works out to a share effect of 714 shares. So 10,000 times 5 over 35 times 6 12s, 714 shares. Individual EPS is 0. Compare that to 67 cents. 0 is less than 67 cents. It's dilutive. And call options will always rank first, right? So, I just put in the rank of 1 for them. The put options are not in the money because the exercise price is lower, so they don't even matter. They're not applicable. Purchase call options, they're never dilutive. Now, what about my 4% convertible bonds? If I look at the 4% convertible bonds, they were potentially convertible for half a year, right? So potential dilution half a year. They were converted into 100,000 shares for the year. So since they were potentially convertible for half a year, 100,000 times half a year, the share effect is 50,000. Now, how much of interest had we paid? Up to that point, up to June 30th, the bonds had paid interest of 250,000 after tax. So that's after taxes. I don't have to worry about doing a tax adjustment on it. It's an after tax number, 250,000. So 250,000 is the income effect because that's from Jan 1st up to June 30th, we had paid interest of 250,000. So on the convertible bonds, the income effect is 250,000. The share effect is 100,000 times half, so 50,000. When I divide 250,000 by 50,000 shares, I get an individual EPS of $5. And when I compare $5 to 67 cents, $5 is way too high. So this is not dilutive. The convertible bonds are not dilutive. If they're not dilutive, ignore. Right? I could only tell they are dilutive after doing the math, right? But if I find that the individual EPS is more than the basic earnings per share, ignore. And then lastly, the preferred shares. So preferred shares, we converted the preferred shares on September 30th. We had paid them a dividend of total of 600,000. And we issued 100,000 common shares on September 30th due to the conversion. So the potential for conversion existed from Jan 1st up to September 30th. Actual conversion or redemption rather occurred on September 30th. So September 30th is my cutoff point. So how long were they, potentially convertible? Jan 1st to September 30th. That's 9 months. So 100,000 shares was the potential number of shares that could have been issued. But that potential only existed for 9 months out of 12. So I got to prorate that. So 100,000 times 9 over 12s. My income effect is 600,000 prorating for 9 months. 100,000 total number of shares converted. But for 9 months, the potential for dilution works out to 75,000. If I divide 600,000 by 75,000, that's $8 per share. That's way higher. So that's not dilutive as well. And last of the lot, they got these 5% convertible bonds. There were 10,000 5% convertible bonds outstanding. Now, if these bonds are to be converted, the interest that we can, these are convertible bonds, okay? So interest has to be after taxes. So let's see. So 10,000 of $1,000 5% convertible bonds. So 10,000, $1,000, 5%. And then we have a tax rate of 30. So 1 minus 30%. The total amount of interest that we can save is 10,000 times 1,000 times 5% times 70%. We can save $350,000 of interest after taxes if these bonds are converted. How many shares will we end up issuing? Well, we have 10,000 bonds, and each bond, the maximum number of common shares that each bond can be converted for is 9. So 10,000 times 9 is 90,000. So again, if I divide 350,000 by the 90,000, that is still higher than the basic EPS. So even that is not dilutive. So this is like a whole lot of, it doesn't matter. It doesn't matter. It doesn't matter. It doesn't matter. And then what's my EPS then? My diluted EPS will simply include just the call option, 714 additional shares. And if I include that, I get my diluted EPS 66 cents. So why did I do this example? You know, it seems like a lot of work, but a lot of those securities end up being non-dilutive. Now, on an exam, you will see a mix of it, right? There'll be something that's dilutive. There's something that's not dilutive. So what is being tested there is your understanding of what dilution really means. And then it is like, you know, it would have to be the King Kong of all questions if I could include everything, but watch out for the ranking, because it is sometimes it may happen that your, you know, the effect on the calculation turns the EPS calculation upwards. And if that happens, you got to stop, because diluted EPS will be the lowest amount, the smallest dollar amount possible.